Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial update with me, Shikhar Garg. Now, yesterday, Fed released their minutes of the previous FOMC meeting, which was somewhat indicating a less aggressive rate hikes in the coming future after a string of 75 basis point hikes, almost four of them. So that's one bit of an update which led for some action in the currency markets yesterday. But other than that, it was the oil prices which fell more than 3% on Wednesday, continuing a volatile streak. I mean, initially it went up, then came down again. Recently, it was on the backdrop of the update that the G7 countries are considering a price cap on the Russian oil. On the domestic front, we had the FDI investment showing some sort of a decline in the first half of the year. So, JK, there's quite a bit of an update. And what do you think? What's going on? What's your take on the FOMC meeting as well?
Yes, good morning. It was perhaps one of the busiest days for the markets just ahead of the long weekend in the US. And the day started with actually a rate hike by Reserve Bank of New Zealand, the quantum of which they have never done. And what's more, they had discussions even around 1% and indicated more hikes in the pipeline faced with the record inflation. That kept the yields elevated in European time and stocks uninspiring. PMIs from Europe and UK were something to cheer about, though they stayed in contraction territory below 50. They were not as bad as the markets had forecast. But the contrast was stark when the survey of S&P Global in US revealed that the manufacturing index there had slipped below 50 and the services index slipped even further. But now being in the both now being in the contraction territory. Before that, the weekly jobless claims for the week ending 17th November showed a hefty rise of 17,000 to 240,000, which initially depressed the yields only to see further slippage after the PMI. So the cup of woos for the US data was complete when the Michigan final reading showed a big decline in November from the readings in October, while the inflation expectations slipped much less drastically. Consumer attitudes have been weighed down by rising borrowing costs, declining asset values, and weakening labor market expectations. Yes, the Black Friday, which is a period when you get discounts on most of the things, also offered discounts on the dollar yesterday after all these negative reading on the data, and it was a perfect setting for dollar base when the FOMC minutes were released. As per the minutes, substantial majority of participants just that the slowing in the pace of increase would likely be appropriate. Slower paces in these circumstances would better allow the committee to assess progress towards its goal of maximum employment and price stability. It also showed that the emerging debate within Fed over the risks the rapid policy tightening could pose to the economic growth and financial stability, even as policymakers acknowledged that there had been little progress on actual inflation. While we did have dovish message from FOMC decision and the statements on November 3rd, the minutes depicted how deeply the members felt about the lag effect of the actions taken so far. This further depressed the yields and the dollar. So my own take is that the slower is not lower as far as the rates are concerned, and we still look for more evidence of inflation dropping before being convinced about a need to pause, while some may be assuming so. The dollar's drop is also equally due to the steadily moving, rather improving macro data from both Europe and UK, and the weight of structural short positions in the respective currencies is getting severely corrected. Hence, we had a rise of 1% in the Euro USD, whopping 2% rise in the GBP, and the dollar was quite what I can say is not partial when it fell, because even the Aussie dollar, New Zealand dollar, and yen also gained against the dollar. Yen's move was close to 1.5%, and the Euro USD actually has crossed the important resistance mark of $200 mark, 200 DMA, while the GBP is very close to it. Even Yuan posted a modest gain to 1.14 from 1.17 after the data. But Yuan's underperformance is understandable, not only because of the high number of COVID cases, but also the rising social unrest about the approach of authorities, with reports of violent protests at Apple's main plant in Zhengzhou region. But perhaps authorities pledging more support for the economy, including further cut in RRR, reserve ratio helped it to recover somewhat. On the yields, yes, the trend continues. 2-year dropped by 8 bps, 10-year by 10 bps, thus steepening the yield curve, which was as much as 85 bps wide at one point of time. The feature of the recent widening differential is the severe worsening of the medium-term outlook for the economy as reflected in the 10-year, while the 2-year is not rising as much despite the many Fed members indicating terminal rate above 5%. For once, even the usually subdued precious metals caught up, albeit with delay. Gold gained 1.5% and silver double of that, and both of them now trade above key technical resistance levels. Not unexpectedly, stocks had a positive close with Nasdaq outperforming Dow and S&P for obvious reasons, because lower interest rates is always good for the tech sector. Dovish outlook on rates, yes, definitely boost the tech sector as we have seen in the past few years. Comprehensive global index of stocks has gained nearly 2.5% in the last 3 days, reflecting calming of investor nerves about finance costs going up. Looking forward to the dollar's direction, definitely we will look to the more inflation numbers coming up, jobs data next month, and also the GDP numbers. But the contrast is very clearly evident. US data is increasingly getting worse, while that of other countries is improving. That's one thing. Earlier, we had only US raising rates heftily. Now we have other countries, like New Zealand yesterday by 0.75%. Canada says that they still have to raise the rates substantially. UK will raise rates by 0.5%. Europe debate is still on between 0.5 and 75 basis points. So dollar is slowly losing that edge against the other currencies, both in terms of the yield difference as well as the economic performance. So it's not surprising that the dollar has come back near the crucial support of 105. Oil moved surprisingly lower even with the lower dollar, as a poor US data meant possible lower demand going forward. And more importantly, players are considering the impact of price cap on oil proposed by G7, which will be implemented from December 5th. Coming to our own rupee, again, it was not so followed by the rupee as far as the dollar's fall was concerned. Unlike the last two instances when there was a big gap down open, I don't think we'll have a similar situation today, and maybe just a moderate strength in the rupee will be seen. It also reflects the reality that rupee's direction is set by its own fundamentals on the external front, which has not seen much of a change. Shikhar, you referred to the FDIs being lower than what it was last year. Yes, I think the macro challenges on the external front is keeping the investors at bay. And secondly, also the valuations of Indian companies may be keeping even the FIs, somewhat on the sidelines for now. But I'm sure as we see the global conditions easing and the financial conditions easing, we may even see a bunched up inflow of FDIs, and so one has to really be not surprised if we see a sudden burst of inflows and a sudden burst of strength in the rupee as well, which will catch up with the dollar index movement. But right now that is not visible. We still see keen buyers on dips so long as the flows are missing. So we will, of course, have a day when there is no cash outflow for the dollar that may actually keep the rupee somewhat better, in better demand for the market. So we wait for more data next week. Until then, we probably go for a quiet trading period after some initial action in the rupee today.
Okay, JK, that was quite good, and I really liked your comment wherein you mentioned Black Friday did offer discounts on dollar as well. I mean, that was quite good. But on the serious note, folks, there still are a lot of structural shorts which are getting corrected, and possibly one of the reasons for which we are seeing the dollar weakness coming in, other than the kind of a losing edge of dollar on the economic performance as well as on the yields, as JK mentioned. The yield curve continues to steepen on the inversion side. Another key thing that happened yesterday was the New Zealand central bank hiking rates by 75 basis points. That was quite interesting to see, as a lot of central banks are acting not so much after deliberation of what the Fed would be doing. And lastly, a day of no cash outflows, as US markets are closed today for the Thanksgiving holiday. So if we have to talk about Thanksgiving, I would like to thank you all folks for providing us all the kind of encouragement and motivation to come out here on daily basis and provide you all the sort of updates that we give. Big thank you to all for being associated with us. And that's it for today, folks. We shall join in again tomorrow morning with another round of updates. Thank you so much for listening.